Well, hello everyone, it's Mark Brown-Cheer, Director General of the Enterprise Investment Scheme Association. We are doing a series of kind of tax planning webinars, talking to some of our fund managers about what they can see coming up in the next year in terms of obviously the two big tax events coming up, 31st of January and 6th of April, and what you might want to look at and what things you might want to think about as an advisor, things you might want to be telling your clients around EIS and SES at this time. So I'm really pleased to have with me Paul Mattick from Mercia. Paul, would you want to introduce yourself, say hello?
Great, thank you very much for having us, Mark. And as you know, I'm a director of Mercia Fund Management, which is the group from Mercia, which runs both the VCT and EIS fund. And so we're here to talk about various tax elements of financial planning. But actually, from Mercia's perspective, we're definitely an investment-led manager. So we are a venture capital firm at heart, with tax products, rather than we're not just a product provider. We have a lot of non-tax assets which we manage.
Yeah, absolutely great point. So I should very much state that you're not tax advisors, I'm not tax advisors. We're just giving out generic information about how the tax reliefs works and how they operate, and trying to give advisors, some ideas about how they can use those tax reliefs. So yeah, very much not tax advice led in that sense, just some ideas and some thoughts as we head into tax year end. So look, I know we talked earlier, we talked about kind of CGT deferral. There's been a lot of talk about CGT, obviously with the Office of Tax Simplification recently as well, making changes to some of those areas of tax, and whether they may or not impact on EIS as well. Do you want to kind of kick off and give us your thoughts around CGT deferral and loss relief as well?
Yeah, so I think CGT and loss relief, I think in many ways the underloved tax reliefs, you want to say that, especially loss relief. Because within a portfolio of companies, the loss relief is available on each individual company rather than at the fund level. So actually, it can provide some really strong downside protection on a company by company basis. And that, again, talking about a venture capital manager, it's really very beneficial. It's an asymmetric return it creates. Just that you can only effectively lose, I think it's 28.5% of the, say 30.8.5% of the each investment into a company at a individual company level with the income tax relief and loss relief, whereas the upside is unlimited by CGT. So that creates not a level playing field straight away. And if you combine that with a manager, a venture capital manager or other, which can deliver at a portfolio level strong returns, Mercia has shown this in terms of one of our tax funds is at 3.3 times cost, and one of our non-tax funds actually at 5.5 times cost. That's fully realized. So you create a venture capital portfolio, surround it with these tax reliefs and downside protection, then that's quite an attractive situation. So loss relief is a key element to what we talk about. And the stage we invest is early. So there are more failures, but they are reported.
And on that point, I'm kind of glad you brought up the loss relief, and because it is an acknowledgement that there are failures within portfolios. That's why you generally have a portfolio of companies, because you hope obviously 2 or 3 or 5 will perhaps go on and be super stellar performers and give you those big returns. But at the same time, within the portfolio, perhaps 2 or 3 or 4 might go bust or not go the way you want them to, and might be write-offs. So just in terms of the share loss relief, perhaps you just run us through the basics in terms of what it is and how it works from an investor point of view.
Sure. So just for simplicity, imagine there's £10,000 invested into a single company, and out of one of the models we do is 150k into a portfolio, and we say we've got 15 companies, so 10k across each, which makes it nice and simple. And the ones that do really well will be hopefully returning 50, 100 plus grand in isolation. But the ones which fail, and we think probably a third of our companies will fail, and we're not quite at that level yet, we're kind of 15%, but we do model for a third of them to fail. So on that basis, say 10 grand into a company. So obviously you'd be able to get, assuming EIS rather than SEIS, so it's £3,000 available from income tax relief, and that seven grand which was left. If a company fails, then you can claim share loss relief against your marginal rate. So that would be 45% normally, and that will deliver £31,500 in loss relief, which can be either claimed against income tax or capital gain, and that those two enable this, say, the strong downside protection. And we provide loss relief letters, and when the company's fully failed, we also have the option to do negligible value claims, which is when the company has been hanging around a bit, is in the process of failing, but an investor can choose to make a negligible value claim. It's basically where, the final process hasn't happened yet, and so we can't officially provide that letter, that loss relief letter. But I think, so I think on a portfolio basis, this is really valuable. And again, we on our model, it will return around £15,000 from the loss relief onto a portfolio level return. I think again that is how we model it in the venture portfolio, and it's probably something which hopefully all advisors know about, all investors know about, but sometimes I find people don't know about it, and that always surprises me, because this asymmetric landscape isn't being utilized.
Yeah, I think share loss relief is a bit like higher rate pension tax relief. The numbers of people who don't claim their higher rate pension tax relief is astonishing when you look at the figures. I think share loss relief is a little bit like, yes, we all kind of know it's there, but we kind of forget about it when we could be claiming it. So I think it's always useful for investors to get those letters that you sound like you send out to let them know there has been a write down.
We have a portal which enables people to collect all of their tax certificates and loss relief letters. And actually, what they tend to do is either financial advisors or the accountants give them login details, and they can get all the information. It's on an Excel spread download if they wanted to as well. So just trying to make things as easy as possible. That's the downside of creating diverse portfolios, is the burden of administration. There's at least one form for each investment, so you could end up with probably 20, 25 forms for one investment with us, which does sound quite a lot of work, but we try and simplify that as much as possible. And diversification, as every advisor knows, is key to risk mitigation. And cross-manager, I think most advisors will be splitting cases across different managers, but also across different companies. I've actually heard from one wealth manager who actually focused on splitting his client's investment across companies. So he looked at how many underlying portfolio companies they had in each fund, and then try and put an equal amount into each company. So rather than saying, okay, this is a 100 grand case, there's 4 managers, therefore 25 each, he looked at how many underlying companies in each portfolio, which it's actually, from my perspective, it makes sense. I never really thought of it in that way. But have you heard of that before, Mark? I haven't heard
of that. No, that's an interesting way of looking at it. I guess it's a clever way of doing it, because you'd rather spread your money across individual companies than you would across funds in that sense.
Yeah. That's I think which came up relatively recently, and is a top end wealth manager, and was quite, and he walked me through it and said, yeah, that actually does make sense, and why don't more people do that?
Yeah, that's a good point. That's actually good thinking it through. I guess you would need, obviously, to know how many companies your portfolio, your fund manager, is actually investing into. But I guess from your point of view, you do know how many companies you're going to invest into, and how much insight can you give that advisor as to who those companies exactly will be? Would you know at that point or not?
Before the fund, we don't tend to give too much information away on a normally, but if there's specific questions, then we can answer them. We probably know. We say 12 to 15, and we probably know at least 5, and probably more like 10. And it just depends which fund the investment's going to sit in. So we've got lots of funds which we're managing all the time. So it's a bit of a moving feast all the time. But we have pretty good insight into at least a third to a half of them before the fund closes, and then after say we deploy over 12 months, and we'll be able to update them on an ongoing basis, and all that information is available on our portal again.
Okay, and I guess kind of taking that theory forward a little bit, and I see from your banner behind you there, well-diversified multi-sector fund. As well as knowing how many companies you go into, how much insight can you give investors at that point about what sectors they'll be going into? So if they particularly like, we had an example when I was a financial advisor. We had a doctor who always wanted to look at kind of med tech and medical-based investments, and that was kind of his thing, or because he had a background in it and had some experience in it. So he was always keen to get a heads up on any companies that are coming through on that basis. How far can you go into it with an advisor or a client on that basis?
So it's our discretion, so that's something we make quite clear, and we basically invest in companies in which we think are well priced and good opportunities and fit with our network. And that tends to fit in with a number of different sectors, and say a lot in biotech, life sciences, and medical side, diagnostics, a lot in software as a service of various different verticals, and computer gaming. We quite like that space, and we've got we've got entrepreneurs which are in-house in all those areas. But we do look at any sector, but we won't entirely concentrate into one or two sectors. It will be diverse, but it's one of these things that, on that same rationale, Mark, I would suggest that perhaps that investors should be focusing on avoiding those sectors, because he's got a discretionary mandate for us. Why would he invest into a sector that he knows when he could do himself versus one he doesn't know when he gets someone else who does know to invest in that space? I've heard that theory as well. When you're talking about single company investing, which we lead, so EIS fund is what we do. There isn't really any discretionary elements of that. But if someone's doing crowdfunding, of course, they would probably look for sectors which they know and understand. Whereas with a discretionary mandate for a fund manager, I think they should be trusting in the manager and enabling them to do what they know well, rather than using their individual knowledge, which might be deep, but it probably be quite narrow in terms of sector to try and inform the investment. So we don't really, I hate to say, we don't give that much discretion on the investors to choose the sectors at this stage. It's just purely it's our mandate, and we'll operate it as we see the best return profile.
Yeah, I see what you mean. Yeah, I guess it's a good point, because it's kind of that investment bias point of view, isn't it? That if you know a sector very well, you should probably actually leave that to yourself to invest into, and let other people who are better versed in looking at other sectors to invest in those sectors at the same time. So that's a good point. I take that. Obviously, again, at this time of year, advisors super busy with tax year end, advising clients. And for a lot of them, probably EIS, SEIS isn't the core of their business. I'm sure they're doing their pension stuff and their ISA stuff. So if they are coming to this a little bit cold this year, what kind of thoughts or ideas would you give to them to be able to go back to clients with around this sector at the moment?
Well, the obvious point is where we are in the economic cycle, but also COVID, and I think
we're doing so well. 8-10 minutes. You mentioned COVID. We got there in the end.
Yeah, well, I think we've got to mention it at some point, haven't we? It's the end of the year at the moment, and it's been quite dramatic year, that's for sure, and it's been very challenging and for various different industries. But as I spoke to you about previously, actually for Mercia ourselves, it's been actually a bit of a transformational year, and we've had a lot of good successes and exits. That's partly because we've been investing into biotech and medical devices and diagnostics and e-commerce and remote work and all sorts of things like that, which have just come of age all of a sudden, digitalization. Going forward, I think the economy is shifting. It's gonna move more and more to where we are now. I mean, progressively, there will be some people going back into the office over the next 6-12 months, but a lot of people have found that the benefits of working remotely. That's a big sector which I think there's going to be lots of opportunities in. The life sciences, biosciences, devices, diagnostics, that is going to be booming for the next 5-10 years. I would suggest that the total cost of COVID is, I'm sure what it is nowadays. I heard it was 25 trillion at one point, but I don't even know what it is.
Yeah.
It's just stupid amounts of money which is costing the world. And there's going to be hundreds of billions of pounds poured into kind of diagnostics and probably masks and all sorts of weird things. And I think that is going to be, we're already in that space, and we're benefiting from that refocus, which is fine. But there are various opportunities around that, and I think we'll see that on an ongoing basis. As you say, COVID is changing the economy, and it will do in some ways. It will destroy a lot of jobs, as we know. It also creates some opportunities for innovative companies, and the ability of small companies to pivot and move into parallel areas is very, very valuable in these times. And I think EIS is very well positioned, even probably better than VCT, which actually suffers from the drag of a historic portfolio. EIS is a new portfolios each time, and they can be set for the new world. And if you can imagine, imagine a VCT had some leisure and tourism assets and it can't get rid of them, whereas an EIS, the next EIS that's launched probably wouldn't have any leisure and tourism assets in them. So it gives an opportunity for EIS to help kind of shape the future economy, and I think we've been doing that for a while. But there's a fast-moving opportunity for that to happen, and we're seeing that all over the place. And it's yeah. And one of the long-term private equity VC guidelines, well, not guidelines, it's just kind of dogmas, is that you invest at the bottom and you get better overall returns, and that's a pretty obvious kind of statement. But if you think there's companies in distress at the moment, and there's companies which are moving into new markets, it means that the pricing of these companies is going to be lower than it would be in boom times. And if we can find and support these companies through the next 5-10 years, which I'm pretty bullish about the next period. Obviously, COVID will drag for a while, and Brexit, don't want to mention that. But there are some challenges, but it's going to be, over the next 5-10 years, it's going to be, I would say, pretty high growth period. So I think that there is an opportunity to seed companies, help grow them, nurture them, give them more capital over a number of years, get them to a point where they can exit at the top of the market. And that's how you get the overall enhanced returns from a VC or an EIS portfolio.
Yeah, like you mentioned Brexit there. We're recording these videos before Christmas, so by the time you watch this video, you probably know what's happened with Brexit. But if you could go back in time and tell us, that'd be useful. Just heading towards, obviously, now we are in the new year, New Year's resolutions. If you could have a New Year's resolution in terms of EIS and SEIS, and kind of to changing the rules or tax policy or anything kind of related to EIS or SEIS, what would you wish for at this time of year? I'm putting you on the spot, I know.
Well, thank you. I'm happy to answer these sort of things. And one thing which it's been very obvious over the last five years or so is the constant changing the rules. And I actually would prefer just nothing to change.
Okay, just a period of calm and stability.
Yeah. However, what I would like to see is that the EIS market to deliver some really big exits. Something which we take a lot of money into the EIS market from various different routes, private investors, yes, and it's a £2 billion
market
a year. And I don't know how many exits we're tracking, but it doesn't seem like £2 billion is going back to the investors at the moment. But what I want to see is that we start returning more money than we're investing, and that's a really big ask. But that's where kind of a mature marketplace should get to, with the tapping into the growth of the SMEs, investing, growing them, selling them. And obviously there's the liquidity is an issue within unquoted stock. But what I would love to see for the new year is some really big exits, some notable, doesn't have to be unicorns. I think that term is overused, and you don't need a unicorn to provide a really good return at even at a single company or a portfolio level. And that's really isn't where we play. We're looking at 50, 100 million pound exits rather than the billion. So what I would like to see, and my New Year's resolution, I don't know how I would make this resolution, my wish, I suppose, see some really big industry exits. And I don't mean just for Mercia, I mean across the board, so that people think of EIS alongside pension, alongside ISA, rather than thinking of it as something which does seem to me as something that is a very niche area, which some financial advisors use, but probably not enough from my perspective or yours.
Yeah, absolutely. I think we're kind of often tagged as an alternative investment. I'm never quite sure where we get that tag, but we'll be increasingly moving towards mainstream for a number of years now. And I think we are a mainstream investment. So, but yeah, I certainly echo your theory about exits and having more of them. As a current recipient of Best Exit Award for ESA, you'll know all too well that I'm always saying that we don't see enough exits, we don't see enough entries for that particular award. So I'm sure that's close to your heart. I did hear a new one recently. It's not a unicorn, it's a soonicorn. So a company that's soon to be a unicorn. So I did quite like that one.
Well, I actually have got one other thing, which so A unicorn's one thing, but actually something else I've heard used is a dragon. I don't know if you've heard this, but a dragon is a company that returns the entire fund value in one exit. And I think that's much more useful for EIS and much more appropriate than a unicorn, because what certainly Mercia is targeting is these companies which selling one of them pays back the entire fund. And that is exactly where we need to get to on it and keep on doing it. So
yeah, I'm going to say in terms of recycling effect, that's far more useful, isn't it? So yeah, brilliant. All right, Paul, thank you very much. I'd say it'll be short and sharp, these sessions. So thank you for giving us your thoughts and your New Year's wish for the year. So thank you very much to you, Paul. Thank you. Take care. Thank you all. We're doing more of these short and sharp videos, so please do catch the next ones as they come along. Thank you very much.
Fingers crossed for a great 2021. Thanks.